IAS 37, provisions, contingent liabilities, contingent assets. What is the logics of this very standard? This podcast is the addition to the videos that you have that visualize the standard, that show you the different cases. But right now, we are going to just remind ourselves what is the logics behind all that. Provision means that we will need to record something in liabilities, which is bad, liabilities is bad, and we would need to record an expense. Or we would record it against the asset, but usually it will be an expense. And as such, profit will fall. And of course, companies don't really want to do that. Contingent liability means that we will not touch statement of financial position, we will not touch P&L, and instead there will be a description in notes. And many users of the financial statements don't even read that far. Contingent asset means that there will be a favorable description in notes saying that we may receive something. It is probable that we will. So you need to understand when each of those words will be applied. Provision will be applied when there has been past event, when there is a probable outflow of economic benefits, and where there is present obligation. So merely intending to cause environmental damage would not obligate us to create provision for environmental damage. And you will need to apply these definitions when challenging the scenario. So a present obligation that arises from past events with the probable outflow of economic benefits. We would need to distinguish between the provision for a large population of items and single events. That is something that the examiner likes to test. So consider this. If you have a lawsuit and there is, let's say, 20% chance that the outflow will be 1 million, it's 30% chance that the outflow will be 3 million, and it's 10% chance that the outflow will be, let's say, 4.5 million, you need to take the one outflow that has the highest chance. So in our case, it will be 3 million and it will be 30%. Because the total outflow probability of just any outflow is above 50%, so it is probable, we will recognize a provision. But the provision itself will be recognized not at the medium, not at the average amount, not at the highest, not at the lowest, but at the most probable, and this 30%. So that is what we're going to use as our provision. But if those percentages would relate not to a single case, but to a large population of items, I would remind you this toaster example. When we sell toasters, there is, let's say, 1% chance that the warranty will cost us $50. It's 2% chance that the warranty will cost us $60 and so on. Because the population is large, then we would use expected values. So each possible outcome is going to be multiplied by the respective percentage. That is the difference that can get tested. We also may be tested on the restructuring position. Once again, merely causing the damage, intending to cause the damage is not past event. It is not present obligation. So for restructuring provisions, we would need to make sure that there is a detailed formal plan. And it either has been communicated to those employees that are affected or has been started to be implemented. And only then we can recognize a provision for incremental cost. Another thing that will be tested is onerous contracts. Onerous contracts means that the cost of fulfilling the contract would exceed the benefit. That would be tested quite often together with IFRS 5 assets held for sale. If you know that, let's say, some of the assets are going to be disposed of, it can be that some other assets will get impaired, IAS 36 will be applied. And also for some of the assets, we are going to have onerous contracts. So for example, when we're talking about the lease of a factory, it could be that we can't cancel it, and the right of use asset and lease liability are going to exceed the economic benefits that we are going to receive from them. So in this case, we would recognize a provision for that. So the contracts for which the unavoidable cost exceeds the benefits that we can receive. We are going to look at contingent assets. Not very often, but still when the examiner likes to do, they like to say that the provision was decreased by the payment from the insurance company. We need to see whether the payment is actually virtually certain, so that it has been authorized. There is a signature from the other party. If it is just a practice that they usually pay, then the payment will be probable but not virtually certain, so we will just talk about it in the comments, but we will not recognize it. So, to recap, you need to remember that provision is something that is in our statement of financial position and maybe in P&L. We need to remember that contingent liabilities and contingent assets are only something that is disclosed in notes. With the contingent asset, we disclose when the cash inflow is going, or any other asset inflow is going to be probable. With contingent liabilities, we disclose them when the outflow is possible. And we need not to confuse the expected value for large population of items with the most likely payment for one-off events. And that is IAS 37. Please be aware of it because it is tested so very often in conjunction with other standards, especially IFRS 5 assets held for sale. And I will see you next.